policy year, which is 12/31/22 to 12/31/23. We're in the process now of the renewal for the policy or policies that will be effective 12/31/23/24. But what we're reviewing is our current program. So I'm going to ask Stephanie to kind of start off and give you an overview of kind of the property insurance market and some of the challenges that we've experienced the last year or so.
Thank you. So the property market has been in a hard state for several years now, and beginning Q4 of 2022, it took a much harder turn into 2023. So what happened was the reinsurance market, which is, you might see on the front end of your insurance, even in your personal insurance, you might see State Farm or Allstate or those big names. Behind the scenes, they're buying insurance themselves to cover their catastrophic exposures to what they're providing on the front end. So that reinsurance market took a pretty hard turn beginning in January 1, but in preparation for that, in Q4 of 2022, the direct market took a harder turn. So those reinsurance markets were cutting their capacity back, not offering the same limits and terms that they had been previously to those insurance companies, and they were requiring higher retentions. And so the markets that we're working with are not able to put out as much capacity as they used to offer, and the costs have increased, and that's been passed along, unfortunately, to the insureds. So, we have seen acceleration of the cost, the rates over, now it's been years, 23 quarters in a row of increases, and then this past year, this year and in the beginning of the end of last year, it's kind of spiked again. Why is that the case? Again, the reinsurance market is reacting to a loss of capital. The capital investors are able to put their money in less riskier investments with inflation increasing and interest rates increasing, and then also just losses. And you can kind of see it on the news, like hurricanes frequencies, tornadoes, hailstorms, winter freezes, just weather in certain geographic areas have changed over the years, and so we're having freeze losses in Texas where that's never been necessarily a concern. So on top of that, with inflation, values have gone up. So that this past year was up 9% on average, depending on the portfolio, you might see higher and lower than that. But so on top of increased costs for the insurance premiums, you're also seeing just exposures increasing because of inflation. With that comes, with all of that kind of comes with more restriction in coverage, unfortunately. So the markets are, again, reducing limits, looking at deductibles, and not necessarily providing some of the enhancements that they may have in the past. I think that pretty much covers it, but we're still in this environment. As Diane said, we're in the early stages of working on the renewal for this year. We are still anticipating increases, so we're not out of that zone yet. But we are hoping that we're going to see some mitigation, at least, that instead of month after month of the increases going higher, we're hoping to see some flattening of those increases going forward.
So overall, we're expecting some increase for the renewal, but not as significant as it was in this current policy period. So this is just a snapshot of our property insurance program. Our property insurance program is a master program, covers High Point community as well as other fee communities and our home health and other operations. But I think this is pretty significant because it shows how complex our program is. We have 22 insurers or participants on our account. So every year go through, but Marsh specifically goes through, works with the underwriters, gets their quotes, their bids, will try to leverage different underwriters, carriers, and so luckily we typically are a little oversubscribed, meaning other insurers are interested in writing on our program, which gives Marsh some ability to then do some further negotiating. So we feel we've got a really good program, even though the market has been very tough, challenging. So this is just a snapshot of what is covered under our property insurance. So it's real property. Personal property really means contents of fees, so not your personal contents in your units, or in your casitas. That should be covered under your own insurance. But what we own, like the furniture in the dining room or in the main social areas, is covered under this property program. It also covers business interruption insurance, extra expense if there's a covered loss and the community incurred expenses outside of their normal operation. It would be covered under that scenario as well. And then there's coverage for fine art, accounts receivable, valuable papers. But it's really based on the physical loss. So when there's a covered loss, it has to have, typically it has a physical property loss, with the exception of some coverage like emergency evacuation expense. Okay, so the coverage is based on a schedule of value that I prepared and put together for all of the communities that identifies the valuation of each structure at each community. So Tie Point Community Association has a number of structures. They all have a valuation associated, but the property insurance program covers up to $350 million per occurrence, which means that if this entire community, which has a valuation of a little under 80 million, it would be covered under that 350 million per occurrence maximum loss. And I mentioned that it's a master program, so it not only covers Type 1 Community Association, but it also covers the other 9 communities as well, and some property, real estate, like our corporate office and other real estate.
One quick question. So just to be clear, it covers property we own, not just property you own.
No, it does not cover property you own.
Well, we own our own houses.
So, okay, in that respect, so yes, it does cover the casitas, the cottages, you call them, correct? It does cover the cottages, the structure of the cottages, as well as some interior fixed property, like your toilets, your sinks, your structure, your permanent structure within your casitas.
I'm new here and had to buy condo insurance, which was a little different for me. 'Cause we always had house insurance. But what I found in all of this is that you, as you have said, do not cover any of our property. So, but you do cover wind and hail. For us to be covered by wind and hail, we have to buy our own wind and hail property insurance to cover water damage if your building was damaged. And it seems to me like that's not fair.
So you would have to buy wind, hail, named storm coverage for your personal property. So good scenario, I think Amy, if she's here, she said if you own like a expensive Oriental rug in your casita or your unit, you would have to have your own personal homeowners, renters, condo association coverage for that. But the flooring, if the flooring was damaged, wood flooring, carpeting, that would be covered under these property code. Similar to, you know, if you had renter's insurance in an apartment, you would cover your contents.
Does it cover appliances?
So I brought it in to see specifically, I can read to you. It covers toilets, bathtubs, showers, bathroom and kitchen sinks, faucets, countertops, bathroom and kitchen cabinetry, doorways, windows, finished flooring, sunrooms, screened-in porches, and I just want to pause there. Those have to be kind of approved improvements, approved by management here. It also covers vents, additions, modification, and improvements above the floor level.
So it would include islands, kitchen
Islands?
islands?
Yes, cabinetry typically is what a kitchen island would be.
But when you say it has to be approved, say I put new cabinets in my kitchen. How do I go about getting approved?
So generally, the additions, so your screened-in porch, any kind of major additions, some have finished lower level. So those types of improvements have to go through an approval process through the management bureau.
Okay.
So the improvement process, what do we need for management so that we have a legal foundation? Should there be that?
I'm sorry, some of the background noise you cut out. What?
Yeah, well, I'm talking about, so what kind of a legal foundation do we need for management in order to ensure that any improvement that is approved of will stand up to an insurance? So in other words, if I improve the bathroom in some way, or the showers and all that, and with the approval of the management, they need to give me a piece of paper or some other document that says that value is their approval.
And honestly, I can't speak to the internal process of the paperwork, but I think a good habit is take photos of your interior so that we can see your cabinetry, we can see your flooring. And our property insurance is going to cover reasonable improvements. So if you have, I use gold-plated, flooring or something really out of the ordinary, it typically would not cover to that extent.
But it's replacement cost, right?
It is replacement cost. So we have a $350 million per occurrence, but it's based on replacement costs. So even though I provide, Mark, who provides the underwriters with our schedule of values, showing the valuation of each structure, if we are showing the valuation as being $700,000, but to actually replace the damages, it's $1 million, it would be covered.
That $350 million per occurrence, is that per property? Because we have 9 properties.
It's per occurrence, so per event.
Okay,
And
so in other words, if there's a hurricane and it comes up the coast, and you have a property in Florida that gets destroyed, and we get destroyed, the limit is $350 million, even though the total value of the 2 properties would far exceed that.
So we are going to talk about sublimits. So there is a named storm sublimit of 80 million. So you really only have 80 million per occurrence. So if there is one named storm that hits multiple communities, it's 80 80 million.
I don't think that that gentleman's question was answered, and it sounds like you're saying the local people have to answer it. So can Mike answer that?
Sure.
Regarding improvements.
I'll do the best I can 4 weeks in. So we might need to get a whiteboard going just to house some of the questions that I don't have an answer to, because I don't want to give you the wrong answer, you know, and then that just stirs up a lot more questions. So, but in terms of management approval, I think was one of the comments. So I don't have a full answer on that, but I'm going to get back to you. But I was thinking the same line as Diane, is that pictures are good, documentation is good. So if you've done some improvements in your apartment or your home, you know, I would imagine you're going to have a contractor agreement and what you put in, and I would imagine you would probably have a file for that. So I'm just sort of thinking back to my home. If I was doing improvements, I would have that on hand, and if there was an insurance claim, I would try to, well, I would want to make sure that that gets into my insurance carrier's hands so they're understanding what we did inside the home. So I would encourage you to keep your documentation. Pictures is always good. In terms of the approval process, I'm going to need to get you some more information. But I do know we have a process for some of the exterior stuff that our governance committee is working on right now in terms of how that process works. So in essence, that is an approval process that you're going through there. Internally, for interior upgrades, I need to get some more information because that is your home. So we just need to get some clarity on that.
Okay, so when you do get the information, how will it be disseminated to us?
So once I get the information, there's a couple ways. I can get it through the board, that can go out in communication. It would be one of the ways that we could get that back to you. Probably the best way would be first getting the board, getting that information to the board, and might go in the one of the reports that goes out, either the board report or one of the committee reports. And then we can get it into your cubbies, into your mailboxes as well.
Thank you.
You're welcome.
Okay, thank you. So this slide covers some of the sublimits that apply in our policy. Although we have a $350 million for fire and all their peril coverage, there are certain sublimits that apply. The limits shown here are really what they would apply to this location, because there is certain sublimits like earthquake that would be different for the California communities. So I'm just going to focus in on the ones that maybe you would be interested in knowing. The name storm, it has an 80 million per occurrence sublimit. Flood, I've highlighted this because the structures here used to be in a special hazard flood zone, and that has a sublimit of 50 million. But in March of 2021, the flood zoning changed, and all of the structures, except the gatehouse, are no longer in a special hazard flood zone. So you have that now 200 million sublimit for flood.
Instead of 80?
Instead of 80.
But that wouldn't apply.
Instead of 50, I'm sorry.
But that wouldn't apply if you were flooded by a named hurricane.
So a named storm would be covered under a named storm supplement of 80. If there was flooding, rain, event that wasn't a named storm, then that would be covered by the 200 million supplement. Okay, good. This property insurance covers also like debris removal, extra expense. So if there was an event where you've incurred expenses outside, that would be covered. Equipment breakdown, emergency evacuation expense. So there have been occasions where this community had to evacuate the community because of a potential named storm event, and that was covered under our property program. We currently have a $250 million supplement on the emergency evacuation.
2.5 million.
2.5 million. Oh, correct. Yeah. Yes, 2.5. Thank you for correcting me. Okay. And then there are deductibles that apply to certain causes of loss. So again, I highlighted the flood because it is $100,000. And that's because of the community properties not being in the special hazard flood zone. If, like, for example, the gatehouse, which is the only structure, if there is a flood, the deductible on that would be $1 million. The name storm, so hurricane storms, has a deductible that's based on the valuation of the structures that incurred damage or loss. So it's based on 3% of the valuations that we have on the schedule of value, with a $250,000 minimum. And then emergency evacuation has the $2.5 million for the limit, but the deductible is $100,000. Water damage claims, so if a pipe bursts in the ceiling and there's water damage, that has a kind of a blended deductible. So some of our participants, our insurance participants, have a little bit higher deductible of $250, others have $100,000. So it's really a blended deductible that depends on the loss. It could be anywhere from $100,000 to $178,000. And then deductibles for all other perils, fire, for example, is $100,000. Yeah, I can. So in the event that there's more than one location, it's covered by the same event, so name, storm, only one deductible, well, I keep on saying that, but it doesn't apply for that. But a freeze event? A freeze is a good example. So if there's a freeze event that hit maybe the Florida communities and South Carolina, there would be only one deductible. If there are two exposures of losses, so named storm and flood, there would only be one deductible that would apply. And this is just a general snapshot of what we are currently valuing this community. So the building valuation is a little less than 70 million. Content only reflects these contents. Time element is business interruption. The putting green. So for the current policy period, the total insurable value is a little less than 80 million. Every renewal, we go through and kind of reanalyze, reevaluate the values, and based on construction increases, we will increase the value. So we are expecting to increase the current valuation by 5%. So the projected TIV for the renewal will be close to 84 million. And then from time to time, we work with Marsh, and they provide a very comprehensive analysis of each structure based on the building materials, age of the building, location, square footage.
Can we get from local administration what valuation is being put on our individual houses for this purpose?
We don't typically get that finite, but it's really more.
I need that for my inside insurance.
Well, it's the valuations that we put together is really more for the underwriters to underwrite the program, because we have that $350 million limit. You're not stuck to the valuation that we've designated for your casita or your unit. It's really more of a insurance renewal process for the underwriters. But in total, we're valuing this community, the assets within the community, at 80 million or 84 million is what we're projecting for next year.
That doesn't help us very much.
So, maybe I can better understand the question. You need it for, because you're insuring just your contents. You're not insuring your building, you're not insuring the flooring or the,
I may be insuring my deductible.
I'm not sure I understand the deductible, because the deductible would be a Tide Point, Broad Creek expense.
On the last slide you had, the first one, what's a BI insurance?
Business interruption. So if you did have to vacate, leave the premise because of damages, you couldn't return for 3 or 4 months, the community would have a loss of revenues. In some cases, maybe they couldn't get houses sold during that period, or people to occupy, so there'd be that adjustment for. All right.
Let me ask one more quick question. You're saying, just so we understand, the $80 million number for the community, the maximum amount we would ever recover less deductibles.
No, the maximum amount for like a fire loss would be $350 million.
For named storm, it would be 80.
Even though, but you're gonna give me more than my property's worth?
It would be not, so it's not market value, it's replacement cost value. So if it whatever it
The 85 million is market value or replacement value?
replacement cost value.
85 is replacement cost value.
Right.
So you would, for all these structures, including yours and the ones that you own, that we own ourselves,
Right, that's how it's being valued.
including our structures that we own ourselves.
Correct.
Yes, so the 80 million is really based on an analysis, right? An actuarial analysis of what the probability would be for the entire community to have a total loss.
For named storm.
For named
Yeah.
storm. We're talking, yeah, we don't.
Let's say a named storm wipes this place out off the map.
Mhm.
Can we get more than $80 million?
No,
No,
it would be
That was
80.
my question.
yes.
So the 350 is irrelevant.
But if it was a fire, for example, in the entire community, then it would be 350. So there are different sublimits for catastrophic type events. Flood is a catastrophic, but there's 200 million. Named storm, 80 million.
But you do have valuations of all the buildings,
Yes,
including the residences,
yes. When you say residents, you mean like
the homes.
yes,
Yeah,
Mhm.
that's what you would have. Yeah.
yes. But that's really used so we can determine what the overall valuations are and to make sure we have the appropriate limits on our program.
And you're saying that's $80 million.
Based on a probable maximum loss exposure, that's what they're valuing it, that any one loss would be less than 80 million.
So I don't understand. My question is, what if the whole place burns down? It's still $80 million.
If it burns down, then it's 350 million. If it's a hurricane,
It's only 80.
it's only 80, right? You know, and those decisions are made based on, you know, this is a barrier.
But a fire is likely to burn one building more than a hurricane is likely to damage one building.
Say that again,
A
sorry.
fire is likely to damage one building
Right,
more than all of them.
right.
Whereas a hurricane is likely to damage all of them.
Right, and when it comes to catastrophe limits, a lot that goes into it is, you know, what the likelihood of that happening. Is it likely that a hurricane will level this entire community? Pretty unlikely, you know, so,
We'd like
well, in any given year, it's not, you know, you probably wouldn't live here if you thought that this whole place was gonna go down in any given year, but, so there's, you know, you use the tools that you have available, and then what is the market bear? You know, hurricane insurance, not inexpensive, right? And so you use the modeling tools. What is the likelihood? I think it's 0.02% that it would ever exceed 80 million in any given year. So you weigh costs, risk benefits, and that's where the 80 billion was landed on. We do get options often for increased limits, and those are evaluated, and then decisions are made, and that's increased over the years or decreased over the years, depending. So But yeah, there's a lot of thought gone into that.
Thank you.
Since we are no longer in a special flood zone, does your flood insurance still cover if there is a flood here?
Yeah, so previously, this was considered, a lot of the buildings were considered a high hazard flood zone, and so the whole community, or most of the community, was subject to a $50 million limit. Now, because it's not considered high hazard, you have the benefit of that higher limit, which is $200 million. And the deductible for most of the buildings outside the gatehouse is $100,000, so.
So you're saying that as individuals, if we own a cottage, we don't have to buy our own flood insurance?
If you want coverage for your personal property,
Well, I understand, yeah, hail and wind and stuff like that.
or for flood.
Or for flood. So if there was a flood and it, you know, whether it's a pipe in the roof, excuse me. You're right. I'm sorry. But if there was a flood and it damaged your property, and only your property, which is unlikely, but if it was your property, it would have to come under your own policy. And then the structure and the fixtures within that structure, when I say fixtures, I mean toilets and sinks, that would come under permanent fixtures, under these property.
Are the deductibles negotiable?
Well, it's always negotiable, right? And we make great, you know, educated decisions based on what the market bears. You know, what we believe in our the analysis, like the reviews, the modeling tells us that we determine what those limits and sub-limits should be.
Several years ago, we had a committee and we did a Zoom meeting with you and negotiated a larger deductible that you would recommend.
So that, I believe, was on, we had a flood deductible buy-down policy. And that was when the structures were in a special hazard zone. It made sense at that time. We also look, at least provide option for a named storm deductible buy-down. But the pricing right now is a little high for the benefit. So we haven't recommended to bind it, but we do present that towards the end of the year prior to renewal.
I'd like to clarify again. You said earlier that our community's premiums are going up 5%?
No, the valuation, so every year I go through the process of determining if there should be any adjustment in the valuations and working with Marsh and seeing what the construction costs are in the different geographic areas nationwide. We look at that, we talk about it, and we are increasing the valuation on the building value by 5%. That may turn out to be a premium increase of anywhere from 15 to 20% based on what the outcomes are. And the market's still a little bit challenging.
Yeah, that's great. So, you know, we try to project what the renewal will look like and the costs will look like for the renewal, but we're still in a kind of volatile market with the property. And also we're still in hurricane season, so things can change if there was an impact of a storm somewhere in the US and the market reacts to that. So we do our best to try to project things, but this past year has probably been the most volatile the market has been ever. So, you know, we think we're comfortable right now in that 15 to 20% overall, but that's subject to change, you know, and we're gonna try to do better, hoping it doesn't get worse, you know, just if the market takes another turn.
Okay. Any other questions? Well, we appreciate you taking the time to hear our presentation, and thank you for inviting us. So, thank you. Have a good afternoon.
So.